Hello my fellow freedom builders and welcome back to the channel. Today's topic is averaging down. Should you do it or shouldn't you? I'll give you the answer in this video. I'll show you why it might not be a good idea in your normal trading, and I'll show you a way I do it where it is actually quite profitable. First of all, what is averaging down? You might know it already. It's also called adding to losers. I normally call it the casino trap, and I'll tell you why. Here we have a stock. It's called Norwegian Air, and it is an airline company from Norway, close to where I live in Denmark. Now, it made a reverse split, so the 13,000, 14,000 here was actually just 130 and 140, so I'll keep talking about these numbers. Alright, back in 18, it was seen as an okay company. They were not making a ton of money, but they were partially state-owned, so people thought, well, it cannot really go that bad with them, can it? So many people bought them up here in the 100, 120, 120. Then it started really to drop and some people kept buying. And imagine if you put, let's just say 3 or 5% of your money into a stock here, and then it starts to drop. And you think it was good value up here, so then it must be splendid value here, it must be fantastic value here, and it must be world-class value here. The thing about averaging down is that you keep lowering your average price. So let's say you bought for the same position size each of these times here, then you would have an average price somewhere around in the 70 or 80s here, and all of a sudden the price is 40. But of course you only needed to go to 80, then you have your break even. But then it starts dropping even further. And I know several good and very stable analysts that thought it was a fantastic value down here around 40, and they bought and they bought and they bought. And as you can see, I know the virus came, and it's not that I'm saying that people should have figured out that this would happen, but let's just have a look at the daily chart here. As you can see, it just kept dropping. And if you would have kept putting 5% or 3% of your capital in this stock all the way down, now this say 54, but it would actually only be 0.54. So the people buying up in the 40 Norwegian kroner or 80 Norwegian kroner would now have half a Norwegian kroner for the stock price down here. Now my guess is that it will never return to these areas up here, meaning that you can all of a sudden have 30 or 40 or 50% of your money put into one stock that will never ever get back to historic levels. That is the real danger with adding to losers. It can be a fantastic idea for a long run, for 3 years or 5 years or 8 years, but all of a sudden you run into something that is not value. You think it is value, but it keeps dropping, and it is actually what is called a value trap. So you keep putting your money into lowering your average price, and all of a sudden you're sitting with a ton of stocks that will never return to former glory. All right. Basically, what I'm saying is that averaging down or adding to losers is a sucker's game in my opinion. So doing this on single stocks, on individual stocks, is a terrible idea. I know some of you would disagree, and you're welcome to do that. Some of you are saying, yeah, well, I'm very good at spotting real value, so I know when to work up a position and so on. Fair enough. We can just agree to disagree on that, I guess. But in my opinion, this is a mortal sin to use this strategy. And if you have been using it, if you started, let's say, investing for 2 or 3 years ago, and it has been profitable so far, well, I urge you to not come up with any stats on it before you have used it for 10 or 20 years, because at some point it will go terribly wrong. Anyway, I mentioned in the beginning that I actually have a way of using this averaging down or adding to losers in a way that is profitable. Now, how is that? Well, the thing is that I never use it on individual stocks because that is simply too dangerous to my wealth. Now, what I do is that, as you might know, I am working a lot with algorithms these days, and we have some different algorithms making some very decent historic returns. Now, what we do when we build an algorithm like this is that we start to give it some data to work with. We have a lot of machine learning capacity and artificial intelligence, deep learning, and so on. And we give it, for instance, the data on the entire US stock market and ETFs from 2008 to 2011. That is 3.5 years. And we ask the computers to work on that to figure out a strategy that would have been profitable in that area. Now, when we have that and we have something where we can say, well, that looks stable actually, we start to give the computer some unknown data. So for instance, we only give it data for this time span here. The computer does not know what will go on in this area here, but we figure out a strategy that works well in 3 or 3.5 years here, and then we give it 10 years of unknown data to see how would it perform there. Now we have a lot of we have 10, 15 other stress tests to make sure we are not curve fitting anything. So when we have a strategy that performs well and that keeps a high Sharpe ratio and a low or relatively low volatility and so on, well, then we might start to work our way backwards. And in this time span here, it was a bit problematic because we didn't have ETFs, the ETFs we needed for our hedge before 2008. But we simulated some ETFs, and it actually seemed that both 10 and 15 years back in time, the strategy works quite well. So when we are finished with all our testing and we can see we actually have a strategy here that seems to work quite well, then I can start to add to losers. Now, what do I mean by that? Well, let's say, for instance, that we started investing around here in 2008. Let's just say this was the time. And all of a sudden, we saw a drawdown in the strategy at around 10%. Well, we can see from the historic development here that 8 to 12% is actually very normal for this strategy. So what I do when I have an extremely well-tested strategy that I'm also traded live with real money to make sure that it does what it is supposed to, then I start to add money to my strategy whenever we see a drawdown in the 7 to 10% area. So I could add some money here and here and here, maybe here and here. And this is how to add to losers. It is not adding to a single stock, because at least my philosophy and in my optics, I would say that no one can predict what way a stock is going. We can have a theory about it. We can have some thoughts about if they're growing right and if the CEO is good and so on and so forth. But if we're looking back on the Norwegian Air or whatever stock we're choosing, no one could predict here from the up from the 40 level. No one could predict if this would go to 100 or to 1. But in a stock strategy, in a well-tested stock strategy, we can actually have a large numbers game, because in the strategy, we don't know which of the stocks and which of the ETFs will give us the profit. But we might have over thousands and thousands of well-tested trades. We might see that we have profits in, let's say, 62% of the cases. And we can see that the winners are, let's say, $150 and the losers are only $80. That gives us what is called a positive expected value. Now, no strategy just goes up like a straight ruler here. So there'll always be drawdowns. But if I trust my strategy and I trust my test of this strategy, then I have absolutely no problem in buying on the dips on the strategy, meaning that we might be in 25 stocks and 8 different ETFs. So I'm not speculating which one of the stocks will go up or down and averaging down on this single stock. No, I'm doing it on the entire strategy. So what I'm urging to you, it's not necessarily that you use my strategy, of course, but if you have a strategy of your own where you can see you're buying from technical analysis or fundamental analysis or a mix or whatever you're using, if you have something that works and you can see you have tested it for years and years, you have tested it through different market regimes in increasing interest environment and decreasing interest environments and high inflation and low inflation, and you have stress tested it in every single way and you trust it, then I think the way to average down is that whenever your strategy is in a drawdown, let's say you can see that your strategy gives you a drawdown of 10%, maybe 4 times it per year. Well, then there should be no problem in adding to your portfolio. Save some money from your salary or whatever you're doing. Every time you have some spare cash you want to put into your investment, then don't start to average down single stocks. Start to average down your strategy in a way that when you trust it and you have tested it thoroughly, then start adding money to your entire portfolio whenever you see a drawdown. In my opinion, that is a very solid and stable way to get some extra profit. For instance, this year on my own strategy, we were in a drawdown of, I think it was 6 or 7% here in February. That was a very volatile market in a way that didn't suit my strategy that well. And I had some spare cash that I wanted to put into it. So when we hit a drawdown, I think it was of 7%, I simply just added some money, both to my normal account and to the eToro, where people can copy trade us. And that is almost back in break even now. So I have been given, you could say, a free 6 to 7% extra on top of the normal CAGR, compound annual growth rate, I could expect for a single year. Then buying on the drawdowns, on the dips, on the entire strategy gives me a very good advantage to squeeze some extra profit from it. I hope this makes sense. If it doesn't, then write your questions below the video. I know it is a bit technical and a bit mathematical, but I hope it should make sense. I try to build it up in a way where it should, in a visual way, be explained quite well here. Otherwise, just ask me below the video. Remember to subscribe to the video, and of course, as always, I have put some links to both my eToro account and all my favorite tools, etc., underneath the video. I'll talk to you again soon. Take care of yourself and your money out there. Bye for now.